Imagine you picked one stock today that could dominate mobility in 2026. Will it be the high-flying innovator, the ride-hailing platform, or the stealthy global volume machine? Stay with me. By the end, we'll break down which company might win, which might struggle, and why your decision in 2026 could look very different than the headlines today. We're comparing three very different business models: Tesla, electric vehicles plus energy plus autonomous ambition, Uber Technologies, ride-hailing plus delivery plus mobility platform, BYD company via ADR, Chinese EV/battery giant, volume leader. Why 2026 matters. The next 1 to 2 years will determine who executes major shifts: battery tech, global expansion, autonomous mobility, regulatory environment. For you, the beginner investor, think of these as three buckets of exposure to the mobility plus electrification wave, each with different risk reward. Let's start by breaking down the fundamentals, because this is where these three giants, Tesla, Uber, and BYD, go from same industry hype to completely different economic realities. And it starts with something most investors overlook. These companies are not competing in the same game. Tesla is valued like a tech monopoly. Uber is valued like a mature platform. BYD is valued like an old school automotive manufacturer that just happens to be growing faster than both. So let's begin with the basics. Valuation. Tesla is sitting at a market cap of $1.34 trillion, which puts it in a different league altogether. Its trailing PE is 278, and even looking forward, analysts still peg it near 196 times earnings. That alone tells you something. Tesla's stock price remains entirely dependent on long-term belief. Investors are paying huge multiples today for revenue that may not exist until late this decade. Uber, meanwhile, looks like a bargain next to Tesla, but only in comparison. Uber trades at a PE of 11.5, which is closer to a traditional business with real cash flows. On next 12 months earnings, about 26 times, still reasonable for a company that's finally turned profitable. But unlike Tesla, Uber isn't priced for explosive growth. It's priced like a company that has already hit its peak growth and is now scaling margins. Then you have BYD. This is the surprise. Despite being one of the world's largest EV manufacturers by volume, its PE ratio is just 20.6. That is shockingly low for a company growing revenue at 35% annually over 3 years and expected to keep growing double digits. BYD looks like an automaker, but its fundamentals look more like a growth company. Investors are getting growth at a discount multiple. If valuation was the only thing that mattered, BYD would already be the winner. But we need to understand what backs those valuations: revenue, margins, and growth. Tesla brings in $95.6 billion in annual revenue. Uber generates about $49.6 billion. BYD, on the other hand, is doing the equivalent of $118 billion in revenue. So BYD is actually the largest business by revenue. In fact, BYD produces more vehicles than Tesla and is growing at similar or faster rates. But the key difference is margin. Tesla has long been known for industry-leading margins, but those days have faded. Tesla's gross margin has slipped to 17%, and EBITDA margin sits at 11.3%. BYD is surprisingly close. Gross margin is 18.1%, EBITDA 13.8%. The big thing here is scale. BYD builds both cars and batteries in a house. Vertical integration helps them keep margins stable even when EV pricing collapses. Uber, however, is the margin monster. With a gross margin of 34%, it dwarfs the automakers. Uber doesn't build cars, it doesn't manufacture anything. Uber is a software platform with low variable costs, and that shows up in its 33% net margin, something Tesla and BYD could only dream of. But the catch? Uber's margins aren't from explosive growth, they're from operational efficiencies and cutting costs. That matters because it limits future upside. This is where the comparison gets interesting. Tesla's revenue growth over 3 years, 8.5%. Over 5 years, 27.7%. But the most concerning stat is diluted EPS growth, down 23.6% over 3 years, 52.7% over 5, barely 15% expected over 10. Tesla's earnings have become volatile, and analysts aren't projecting massive profit growth near term. Tesla is no longer a hyper-growth company by the fundamentals, it's becoming a cyclical one, driven by competitive pressures and price cuts. BYD, however, is still very much in hyper-growth mode. 3-year revenue growth, 35.4%, 5-year, 43.4%, 10-year, 28.9%, and earnings, Diluted EPS up 54.9% over 3 years and 62.7% over 5. This is remarkable. BYD is growing revenue and earnings faster than Tesla, yet trades at 1/10 the valuation. That's why so many analysts argue BYD is the world's most underpriced EV stock. Uber's growth sits between the two. Revenue up 19.5% over 3 years, 35% over 5. Not bad. Solid, steady growth. But earnings growth is mixed. Diluted EPS up 19.7% over 3 years, but slowing to just 14.4% over 5. And forward EPS for next year expected to fall 11.8%. Not a great sign. Uber has matured. It isn't in hyper growth anymore, and analysts can see that. Tesla holds $41.6 billion in cash and effectively has no net debt. Uber holds $9.0 billion in cash with $1.48 billion in net debt, which is manageable. BYD has 175 billion Chinese yuan in cash, but carries some net debt, normal for a manufacturing heavy company. Tesla is the clear winner for strongest balance sheet. Uber is stable. BYD is capital intensive, but not distressed. Tesla's PFCF is 196, which is extremely high. It suggests the market is paying a massive premium relative to Tesla's cash generation. Uber's PFCF is 21, extremely reasonable. BYD's PFCF is 5.1, which is absurdly low for a company growing this fast. This is the single biggest sign BYD is undervalued. Tesla is the premium story stock. You're paying for what Tesla might become. Robotaxis, AI, autonomy, energy storage, you name it. But the fundamentals right now do not justify its valuation compared to its competitors. Uber is a maturing platform, profitable, efficient, and reasonably valued. The upside is limited, but so is the downside. BYD is the fundamentals winner by a mile. It's growing faster, earning more, scaling larger, and trading far cheaper than both Tesla and Uber. If this analysis was completely blind, no logos, no hype, 99% of investors would pick BYD based purely on fundamentals. But the market doesn't always pick the best fundamentals. It picks the best story. And Tesla still owns the story. Now let's talk about the business models a bit more. For beginner investors, think of these companies as 3 different ways to invest in the future of mobility. Tesla represents innovation and premium technology. Uber represents the global mobility platform. And BYD represents scale and cost leadership. Each path comes with its own type of growth and its own type of risk. Let's start with Tesla. Tesla focuses on premium electric vehicles, energy storage, solar, and long-term plans for autonomous driving through its next-generation platform. The company still holds powerful brand recognition, and in many markets it remains the benchmark for EV design and technology. Heading into 2026, Tesla's biggest opportunity is its next-generation vehicle. If Tesla can deliver a lower-cost car with improved battery technology, it could unlock a much larger customer base while protecting margins. At the same time, its energy storage business continues to grow and could eventually become a major profit engine beyond cars. And of course, the long-term robotaxi narrative still attracts investors who believe Tesla will lead the autonomous future, but the risks are real. Tesla must execute perfectly on cost reduction and scale. Many argue that its valuation already prices in years of future success, meaning any misstep could lead to sharp downside. And competition is rising globally, especially as other automakers scale their EV lines. For 2026, Tesla is a classic high-risk, high-reward story. If it nails the next-gen platform and expands its energy business, the upside is big. If not, the stock could disappoint. Now let's look at Uber. Uber is fundamentally a platform business, not a car manufacturer. Its strength comes from its global network, its data, and the scale of its ride-hailing, delivery, and mobility ecosystem. In recent years, Uber has pushed into freight, healthcare transportation, and partnerships in autonomous mobility. By 2026, Uber's advantage is that it doesn't need to build cars. If it can grow its highest margin areas and continue increasing profitability across rides and delivery, it could become one of the strongest cash-generating companies in mobility. Its global footprint also gives it a wide runway to scale. But Uber faces its own set of risks. Autonomous vehicles could disrupt its core core business if robotaxi networks grow faster than expected. Regulation around gig economy labor could increase costs, and competition from local ride-hailing companies or vehicle makers entering mobility services is always a threat. Many analysts expect steady but not explosive growth for Uber by 2026, unless autonomy or freight gives it a major tailwind. It's a more moderate risk option, but still highly dependent on execution. Then there's BYD. BYD is a Chinese electric vehicle and battery giant, and unlike Tesla, it focuses heavily on the mass market and affordable segments. It benefits from deep vertical integration, making its own batteries, components, and even some of its own chips, which gives it a cost structure that many competitors simply can't match. Heading toward 2026, BYD's biggest strength is scale. As EV adoption increases worldwide, BYD is positioned to win large volumes of customers, especially in China and emerging markets. Its low cost advantage allows it to expand aggressively into new regions, often undercutting global competitors. This gives BYD a strong growth profile even during price wars. But BYD isn't without challenges. High volumes can sometimes mean tighter margins. Global expansion brings political and regulatory risks, especially around tariffs and trade tensions. And while it's an execution machine, BYD doesn't always offer the same dramatic leap potential that Tesla's innovation narrative does. Now let's compare the three. Tesla is the big swing. High risk, high reward. Its future depends heavily on whether it can execute on a major technological leap. Uber is the platform play. Moderate risk, potentially stable returns, but sensitive to regulation and autonomous disruption. BYD is the scale machine. Strong growth potential driven by affordability and global expansion, with fewer wild swings but also fewer moonshot moments. So what does this mean for investors? It comes down to what you believe the mobility world will look like by 2026. If you think premium EVs and autonomous breakthroughs will define the next cycle, Tesla might be your pick. If you think the world moves toward platforms that control transportation and logistics, Uber becomes more attractive. And if you believe EV adoption will explode in the mass market globally, especially in China and emerging regions, BYD offers the most direct exposure. If I had to highlight one for a beginner investor with a moderate risk appetite, BYD might be the most balanced choice. It has strong fundamentals, clear growth paths, and doesn't rely on a single breakthrough to succeed. Tesla is still the exciting pick with major upside if everything goes right. And Uber remains compelling if you believe platforms will dominate mobility. But keep an eye on regulation and autonomy. Whichever one you lean toward, think in terms of a 2 to 3 year horizon through 2026. Pay attention to production milestones, earnings, new regulations, and any updates around autonomy. And most importantly, avoid letting hype drive your decision.